Hey everyone, it's Dale Anderson here. Hope you're keeping well. So, I hadn't intended to spend so much time this week on the unfolding banking crisis. I'm old enough to remember the last crisis of 2008 when I was younger and starting out in my career in London and the disaster that followed. So, banking has become hugely profitable for bankers and wildly dangerous for the rest of the economy, as you can see recently with the collapse of Silicon Valley Bank and now the issues with Credit Suisse. So I just wanted to quickly update you on what's happening so you can better understand the situation. This week shows why just days after three national banks collapse and a Federal Reserve bailout, the great bank run of 2023, the entire banking system could be a lot bigger than expected. So if you haven't already, please do subscribe, like, and share with the channel. We really appreciate it. And then, yeah, let's get into the video. So another domino is about to fall, one of the largest banks in the world, Credit Suisse. The situation is so bad, their share price collapsed 97% down to $2. Some believe this is the start of a slow rolling global crisis. So given these claims and just how interconnected the entire banking system is, let's break down exactly what's happening, what this means for the entire market, if there's a chance of more banks failing, and finally, what you can do to ensure you're best protected. So to grasp the situation, you need to understand how the banking system works. To do that, introducing you to Credit Suisse. Credit Suisse are one of the most prominent banks with over $1.5 trillion under management, more than 50,000 employees, designated as one of the most systematically important financial institutions of 2023. Simply put, they have a massive impact on the markets, a variety of money-related transactions, and ranked as one of the necessary banks that keeps the global economy going. One of the banks indeed considered too big to fail. However, a quick look into their past does give us a slightly different picture. In 2017, Credit Suisse was fined $5.28 billion in connection with its sale of residential mortgages, backed securities which were overvalued during the financial crisis of 2008. This resulted in the loss of wealth and a painful toll on many. The settlement announced the bank knew they were offering loans that were likely to fail. And that's just the beginning. In 2009, they forfeited a further $536 million for violating of the International Emergency Economic Powers Act. By 2014, they were found guilty for assisting US taxpayers in filing false returns, paying another $2.6 billion fine. In 2019, they were caught spying on their top executives, resulting in forced resignation of their then CEO. In 2021, they lost $4.7 billion from a failed investment fund that defrauded its clients. In 2022, to make matters worse, their clientele was leaked, who were considered fraudsters, criminals, and corrupt politicians right after being found guilty of money laundering. So just before the year ended in 2022, they paid $495 million to settle a mortgage fine. In terms of what's happening today and why people are concerned about a second and much more worse crisis or banking collapse, at the end of 2022, the CEO, Ulrich Kunner of Credit Suisse, made a statement that says the bank is at a critical moment and tried to reassure employees not to confuse the day-to-day stock price with the firm's strong capital base and liquidity position. Why would they say this? In addition to their stock price having declined by over 90% over the last decade, they're about to do a major restructuring to try and get the bank back to profitability. In doing so, they needed to raise capital, which seemed like a last-ditch effort to stay afloat, such as the Lehman Brothers did right before their downfall. In order to operate, banks need to pass a stress test to ensure that they could survive a wide variety of financial conditions. Their previous results were less than optimal. Yahoo noted that their Tier 2 capital was lagging behind regulatory requirements, which means the bank lacks the necessary capital to restructure successfully. After that was released, everything broke loose. Once investors started to dig deeper into the company financials, critics warned of their path moving forward, declining revenue and dwindling returns, which could have a significant impact on the entire markets, which is only going to get worse. In 2022, customers of Credit Suisse withdrew billions from their accounts, contributing to their biggest annual loss since the financial crisis of 2008. In February 2023, the Federal Reserve stress test revealed that Credit Suisse was exposed to both global market shock and counterparty default with connections globally. On March 14th, the bank said they found material weaknesses in the financial reporting over the last 2 years due to ineffective internal controls. As one of the largest banks says, this customer started to panic, as reflected in what's known as credit default swaps. Sounds complicated, right? Well, imagine this. Anytime bank issues a loan, they have an option to purchase a credit default swap, which acts like an insurance policy in the event the borrower doesn't pay it back. In this case, one bank is able to transfer their risk to another bank for a small fee, and then the second bank takes on that risk. In the event the second bank has to pay the first bank, they are out of luck as assume the rights of the underlying investments, and they're collecting enough of a premium from other credit default swaps to offset the risk. However, if the bank issues too many credit default swaps, they don't have the cash on hand to issue all of the insurance payouts, then potentially they will be forced to raise a huge amount of cash to cover the deficits. And if they don't, then they can go under. This is what we saw in the 2008 financial crisis, when banks like Lehman Brothers collapsed from a lack of capital once they could pay for non-performing loans. Concern is history is repeating itself, except there is a twist. Credit Suisse is one of the biggest buyers of US home loans. Their customers are withdrawing the money at the fastest rate in decades. As of today, the cost of the credit default swap skyrocketed to its highest level in history, implying investors are beginning to bet on the entire company's demise. So what does this mean for you, your money, and the market? All of this stems from the Silicon Valley banking collapse, which resulted in heavy scrutinization across the industry, with Credit Suisse thrown back in the spotlight. The last year, their co-head of banking suddenly left after 9 months of being promoted and 27 years of working with the company. They have continued to be in the losing end of bad trades, with most recent trades resulting in a 6.5 billion US debt that they will be stuck with indefinitely. As a result, they cut back operations and cut 9,000 employees, but with an £800 million pending lawsuit and other issues, they're at the point to make a pivotal move. Not looking good. Simply put, people were taking their money out of the bank that was already losing a lot of money to begin with, and that exacerbated and continued to exacerbate liquidity risks, which is a fancy way of saying they were running out of money. To make things worse, their largest investor, the Saudi National Bank, said they were not giving them any more capital or increasing their position with the bank, with their exact words being, the answer is absolutely no, for many reasons. The simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it will be our regulator or the European regulator or the Swiss regulator. So what will happen with Credit Suisse being the next big bank to fail? This will have a devastating impact on the entire banking system and economy, as we have already seen. For example, when Lehman Brothers collapsed from over-leveraged mortgages, bankruptcy resulted in over 25,000 job losses, a complete credit freeze as loans dried up, and losses across the entire market as investors worried about their own investments would be affected. On top of this, more than 75 other bankruptcy proceedings followed the bankruptcy of Lehman Brothers, so the fallout wasn't limited to one company. If people lose faith in the banking system, there's a concern that more people will panic and start to withdraw their money, resulting in worse bank runs, liquidity issues, and further consolidation into the banks that people believe are too big to fail. In this case, Credit Suisse is listed as a systematically important financial institution, meaning they deemed to pose a serious risk to the economy if they were to fail. This was a designation created back in 2010 as a way to enforce stricter oversight and regulation within the banks, which have significantly large effects on our economy. The government's way of ensuring these companies operate as responsibly as possible, which is laughable given everything they've done. To answer your question on whether or not you should be concerned, it's possible, but given how large they are, it's rather unlikely they will go completely under. In fact, with 24 hours of Credit Suisse facing financial difficulty, the Swiss National Bank said that they would provide liquidity if needed. Essentially, they're promising to backstop any losses until hopefully the bank can regain profitability. All of this was done to calm down markets, knowing if consumers have faith in the system, they're not going to all rush for the exit door at the same time, and that's going to spread throughout the entire company. This leads me to believe that despite the headlines, there can't be a serious danger in the market, but investors should diversify their portfolio just in case. Companies like Credit Suisse have grown to the point where they could be subsidized by the government if required, if the event their downfall would negatively affect the rest of the world. BlackRock's Larry Finn disagrees with this and says this is simply the domino effect starting to fall after years of low interest rates and easy money. The savings and loan crisis that began in the 1980s and lasted almost a decade to unfold, with thousands of lenders being completely wiped out. I believe Credit Suisse will be bailed out. They get a slap on the wrist after receiving over 11 billion fines in the last 20 years, and life goes on until the next one. It seems they will be backstopped for the foreseeable future, but for now, you should make sure you diversify, make sure you're under the FDIC or FCA limit, and understand panic can sometimes create good buying opportunities as well. You could also ask ChatGPT, as it actually predicted the market would crash on March the 15th. Coincidence? Let me know what you think in the comments below. We hope this helps. As usual, please share, click like, subscribe. Take care, stay safe, all the best.